Well, folks, yesterday on the channel we reacted to three bearish videos, and so I thought, okay, after yesterday reacting to three bearish videos, let's do an all bullish video here today. And so that's exactly what we're going to get into. Two videos for me to react to, one image for me to react to, and this one, okay? First video up here I want to react to, this is a short-term pullback and not the beginning of a corrective phase. I want to listen to what they have to say in regards to that. Then I want to react to this video. We think the market is at the beginning stages of a bull market phase. Okay, that's interesting. So we'll react to those two, which are definitely leaning very bullish. And I want to talk about this image here, okay? Somebody in the Palantir chat inside the private stock group, which we have a ton of Palantir investors in the private stock group, right? Always sharing different content, different news, different information, different perspectives in regards to Palantir. And somebody shared this today, and I just was like, this is brilliant, okay? So based on Palantir's earnings call, this is the AIP strategy. I think it will work well for Palantir over the long run. Now this is very, very intriguing, okay? So Palantir in their AIP product, you know, Karp said on the conference call, we'll figure out a way to monetize it, right? There was a very bad look for you know, Wall Street, in my personal opinion. You know, when you say, like, we don't really know how we're going to make money, but we're going to figure out how to make money from this thing. It's not a good look, and that's one of two reasons why this stock is $15 here today instead of $20+ after earnings, right? There's two core reasons. The first reason is because of what Karp said in the conference call. The second reason is only coming in line for those earnings that was, you know, not good. Like, bottom line, not good. If you just come in line in your stock that's up like 200% this year, or 150%, whatever we were going into those earnings, you got to come through and smash it if you want to have your stock keep going up. You come in line, oh, you know, put everybody to sleep. And so that's obviously what's kind of going on here, but it's an interesting perspective because you could make an argument that they're just using AIP as just a Trojan horse to then go ahead and sell companies that are interested, sell them Foundry, Gotham, Apollo, different products in general, right? So I do think it's an interesting strategy. I do hope they can make hopefully a lot of money from AIP over time. It just seems like it's more of an, at least in the short term, very short term, it seems like it's more of an attention grabber to ultimately sell their main product. So interesting perspective. I'd love to hear your guys' perspective here if you're a big Palantir shareholder and you have in-depth perspective on this. I would love to just hear your perspective in the comments section. I know there's a lot of people that watch the channel that are very well educated on the stock that might have an opinion on that image there, and if you think that's kind of what's going on there, or you think it's something different. So appreciate everybody joining me. As always, record high subscribers and appreciation. This channel is appreciating greatly, okay? That's the way I want to put it. It's appreciating greatly, okay? 33,000 plus subscribers. We're the hottest stock in the market, and I appreciate you guys being here. Let's go ahead and get into this.
Best bets to weather the storm. Fairlead Strategies founder and managing partner, Katie Stockton. Katie, always good to have you. Good morning.
Good to be with you.
So what happens if we do get back to that 50-day?
Well, it is initial support for the S&P 500. It'd be a natural place for a bounce to develop. Unless it's broken, I think we have to trust that this is a short-term pullback, not the beginning of something in terms of a severe corrective phase. We have seen some impact, of course, to short-term momentum. That prompted our downgrade to short-term neutral. We've been short-term bullish since May in our research. And yet, if we see it carry over to our intermediate-term indicators, that's where we're going to start to recommend, you know, hedging strategies and managing risk. Because if we see the downturns carry over to those gauges, the implications would be for up to 2 to 4 months of corrective price action. And that, of course, is something that would be worth repositioning around. One easy thing that
So before she goes further, I disagree with her. I think if you're the type of person that's a higher net worth individual and you are considering hedging, I think it's a great time to be considering hedging over this next few months, regardless of what these technical indicators tell you or don't tell you or all those sorts of things. I think if you're scared at all about 2024 and you have a good amount of money in the market, you don't want to really sell your great stocks. Like, why would you want to sell, you know, let's say you hold 10, 15, 20 stocks and you love all those stocks. Like, why do you want to sell them? You don't, right? And you might feel like several of them, many of them, most of them are undervalued. So why would you want to sell those and try to time out that? It's usually a poor decision, right? But to hedge a little bit, you hedge properly, that can go a long, long way for protection for 2024. So I believe you should actually be, over this next few months, looking for hedging opportunities for 2024 specifically and taking advantage of those. That's my personal opinion. Don't wait for some technical indicator to tell you, okay, now's the time to hedge. No. At the end of the day, like, the VIX has been in a very low place for the past several months. Puts are relatively cheap, you know. So, yeah, these are things to consider, and a lot of stocks are very, very high, especially in large cap land.
Watching is the 20-day moving average. It is still pointing higher for the S&P 500, but with all the weakness from the likes of Apple and Microsoft and Nvidia, the NASDAQ 100 seems to be losing the support of its 20-day moving average. And in following, we actually moved to an equal weight bias for the technology sector, which we previously had been overweight. And that bias we could maybe stay with just for a couple of months. But to us, it does seem prudent at this time.
Yeah, you mentioned the NASDAQ. We just mentioned Nvidia. Apple had its worst day of the year on Friday. Is there a sense for you technically that...
So the problem with a lot of these individuals, like a Katie Stockton, because I've been watching her for a while, and you know why? You know who actually used to talk up Katie Stockton a lot last year? Was Maverick from Maverick of Wall Street. He would talk up Katie Stockton a lot last year. And he doesn't talk about her at all now because she's flipped over to the bullish side, right? And so what's interesting about her, especially a lot of these technical people, they're late to the party. They're always late to the party. You know, she was very bearish when you should have been going bullish. Now she's really bullish. I'm not saying you should be bearish, but I think it's definitely a time you should consider hedging and, you know, keeping good cash balance, especially when you can get 4 to 5% guaranteed right now on your money in many savings accounts and through treasuries and things like that. So, you know, that's the problem with these technical people. They have to wait for all these confirmations and things like that instead of just looking at it on a fundamental level and saying, this stock's disgustingly undervalued, I'm going to go buy this stock. They got to wait for it to hit this moving average and this moving average, and then they waste so much time and they may waste so much money waiting for these things to happen, and then things flip the other way, and then they're stuck trying to get some sort of you know, like confirmation the other way before they can sell and make another decision. And so that's why they just lag in a huge, huge way by months and months. And they'll miss, you know, when you are in a big downward market and you miss that first major up phase, you're going to miss 50 to 100% gains in countless stocks. They don't talk about that. They talk about, oh, you might miss 10, 15% in SP 500. But when you're an individual stock picker and you're missing 50, 75, 100% gains in stocks, it's not a small amount of money. There's a lot of money you're missing out on the table, right? And then if you're late to the game on the bullish side, right, and you're bullish in a time period when maybe you should be pulling back or considering some hedges and things like that, you know, then you can obviously get yourself into a whole bad situation on the other side, right? And then you're trying to time it out, like, you know, let's say the market starts going down, and all of a sudden, all these other technical indicators start getting hit that say you need to sell. Next thing you know, you're taking a big loss. Then you're trying to figure out, okay, when are my indicators going to tell me to get back in the market? That's a whole mess, man. That's a whole flipping flapjack and mess. That's all I got to say about that.
We do lose some of the mega cap tech leaders. That can be made up by energy or materials or something else?
I don't think the footprint from energy and materials will be big enough to allow the major indices to forge higher without the support of the mega caps. Noting also that the breadth, while it improved very notably since May, really, now it is also overbought. So the breadth data is poised to come in as well, in the same way that we've seen the sentiment data come in. The sentiment data had gotten to the point where it was suggesting that the market was in this extremely greedy territory. And with the pullback last week, albeit very modest for the S&P 500, we did see that sentiment data come off a bit. And that to us creates another risk, and hence saying that there's increased risk of a corrective phase, even though we don't quite see it yet in those intermediate term gauges. That is, of course, what we're looking for. And we do have it from Apple. We do have it from Microsoft, which failed to get through that 350 resistance level. And if we see a little bit more downside from Nvidia, we'll have it there as well.
What about the relationship between yields and stocks? Because sometimes stocks like rising yields. They signal that we're going to not have a recession and that things are looking better in the economy. And sometimes they worry about it because it means higher for longer in terms of rates, the impact for the Fed, and what that's going to do to the economy.
That's right. The correlations tend to break up over shorter time frames. If we do look for a pullback in Treasury yields and, of course, a rebound in kind in the Treasury bond market, Treasury bonds do tend to do better than equities when equities are in a corrective mode. So we would keep that in mind, certainly. And
by the way, I believe you can get a lot higher return currently on shorter term treasuries in like the 2-year, 5-year, 10-year. I believe you can get well over 5% right now. So if you're looking to place to park money over the next 3, 6 months, year, if I recall, there's several different treasuries yielding 5% plus right now.
Are perceived as a safer place to put your money. For yields, though, we do think that the longer term uptrend is still very much intact. And so once we see the pullback run its course in 10-year yields for one, we would trust that we'll see more upside from yields. And then, of course, we'll have to recalibrate accordingly. If we were to see a breakout above about 409, that's a resistance level for the 10-year yields, well, then the next resistance is 434, and that could certainly have an impact. But for now, we're looking for a retracement back to about the 50-day moving average. That's around 384 at a minimum.
So if we get a major drop in the market, let's say hypothetically, whether it be in the next few months or whether it be next year at some point in time, I think we could see a pretty nice market drop, but I do believe it would be somewhat limited. And the reason I believe it would be somewhat limited from what it could really be is all this flip and flapjacking money in treasuries right now. There's so much money locked up in 6-month, 3-month, 1 year, 2-year treasuries that if treasuries start yielding less, right, then a lot of people, when basically they have access to the full funds there, they're going to go ahead and potentially put that money back into the market, right? And so that's where things are going to get very interesting in the market. That is, kind of a different scenario than maybe you had in, let's say, 07, 08, 09. You didn't have this sort of money over there in treasuries, just collecting 5% easy money, just waiting, see what happens here. And so anyways, that's just some food for thought that I don't think a lot of people are considering right now. I think should be considered. Alrighty, next video up there. This one I'm really looking forward to. We think the market's at the beginning stages of a bull market phase. Wow, that's a big statement.
After yesterday's sell-off, joining us right now is Mona Mahajan. She's the senior investment strategist at Edward Jones.
By the way, this is what makes a market. This is what's so beautiful, man. Yesterday, we react to all those bearish videos, all those individuals so bearish, right? And then you got other people that are very bullish, and this person says we're at the beginning stages of a bull market. This is what makes a market, folks, okay? This is what makes a market.
Great nice to be here.
We were on a run, then we were not on a run, then we went on a little one, then we went down. What's really happening here during this crazy earnings season?
It's a great question. And look, we have had a tremendous rally in the first 8 months of the year, call it. S&P 500 went almost up in a straight line from March to end of July. Now, we were hit with not one, but 2 downgrades. Fitch last week, Moody's just a couple of days ago, and yet the market's down about 2 to 3% off its high. So everybody is waiting for this notorious pullback, a period of consolidation, some profit taking. But keep in mind, there is a lot of cash on the sidelines. We know about the CD money and on the retail side, and institutions have that cash waiting as well, ready to deploy. So what we're seeing is 2024 looks like a decent setup. Not only can we see a Fed on the sidelines, potentially moving lower, inflation continuing to moderate, but earnings, we think, improve next year as well. So that's a pretty good backdrop, we think, for risk assets.
So, okay.
Dang, that's nice. By the way, her name's awesome. Like who are you going to believe? When you got a name like that, it's an awesome name.
12 months out, though, what do you think the prospect is for a higher market? I mean, in a world where some people think we already went parabolic.
Yeah. Look, we think the market is in the beginning stages of a bull market phase. And bull markets tend to last, 3 to 4 years.
To be fair, you say, market parabolic. What? The market's not even at all-time highs. We're actually significantly still away from all-time highs, especially on the NASDAQ side. So, it's hard to say a market's parabolic when you're not even at your all-time high right now.
Average. Now, that's not to say markets go up in a straight line forever. There are, on average, any normal given year, 1 to 3 corrections, 5 to 10% range. We have only seen one about 5 to 7% correction during that March financial crisis.
Most years, the NASDAQ's going to be going to hit an all-time high. Most years, think about this for a moment. I think this is super important, and I don't think anybody talks about this, to be quite frank. Most years, the NASDAQ hits a new all-time high at some point during that year, right? We didn't hit a new all-time high in 2022. We didn't hit we're probably not going to hit a new all-time high in 2023 unless we have a beast kind of 4Q or something like that, right? So probably not going to hit. So that's going to be 2 straight years where we didn't actually hit an all-time high on the NASDAQ. Is 24 a year that we finally hit an all-time high? We'll see. I think it really depends on how the economy does in 24, in my personal opinion. And if we, things get bad there or they don't. So if, let's say, it doesn't happen again in 24, then you got 3 straight years you don't hit an all-time high for the NASDAQ, when most years the NASDAQ hits an all-time high at some point in time. So that's just food for thought there, right? And that gets back into the whole, well, are we really in a parabolic market or not?
So we do think, look for some volatility, but use that volatility as an opportunity to, we think, position in both equities and bonds, really.
But why should the markets have a higher than historic valuation, historical average valuation, at a time when interest rates are not 0%? I mean, what is that case? Because everybody mentions this cash on the sideline, but what is going to cause this cash on the sideline to come out and pay, a premium multiple for the S&P 500 in a time when theoretically we shouldn't have a premium multiple given some of the headwinds?
Yeah, look, it's a great point. And of course, we can talk about that Magnificent Seven versus the rest of the market. And we look at it that way, Magnificent Seven, about 28 times next year's earning. If you look at that 493 that's left, about 16 and a half times. So much more reasonable valuations, we think, in the broader market. And so we do think where the opportunity will lie over that next 12-month period is in a broadening out cyclical parts of the market. Think about some parts of the bond market, but also think about international as well. So areas that are much more reasonably valued, we think, have that opportunity. Now, don't wholesale sell out of your AI and tech stocks. We think that's at a beginning phase of a long-term market, but fully valued at this point.
So if that's fully valued, though, you don't think that there's going to be a rotation out?
So
because I think that there could be, and
we've started to see it.
Right. No, but if you get into a rotation situation, the idea of holding the guys that you think are at the beginning of this thing may actually be the mistake.
Well, we think that there probably is going to be some period of consolidation in those Magnificent Seven. Large cap technology broadly, natural to take some profits after a nice run. That doesn't mean their run is over. It means that, for now we could see that market shift to the broader parts of the market, the cyclical parts of the market, where the economy levered to an economy that's doing well. But longer term, that valuation will catch up to the earnings potential, and we do think.
Okay, so I always get emails from viewers who say, "Don't just tell me stocks. I buy mutual funds. I buy ETFs. I buy indexes and things." What would you do in that regard?
Yeah, absolutely. Look, ETFs are a low-cost way to play the market. You can't go out and buy 500 stocks on your own. So we do think there's real value in the ETF space and in some mutual funds that are actively managed. When we think about good opportunities for active management, maybe not large cap technology or large cap stocks, but small cap stocks, parts of the bond market, really good areas where mutual fund managers can get an advantage. So certainly we think there's opportunities there. And we think about bonds, longer duration, starting to make a lot of sense here as well.
Yeah, so I disagree with her. I think rather than picking up ETFs or mutual funds or any of these things, pick your own stocks. You can make your own money. You can lose your own money, okay, just as somebody else can. And I would much rather invest in my own companies that I truly believe in for the next 5-10 years than have somebody else do that on my behalf, who's probably not going to pick the best stocks, let's just call it that, and probably not run the portfolio very well, versus somebody like myself that's going to put an immense amount of time and effort. No one cares about your money more than you care about your money. Think about that for a moment. No one cares more about your money than you care about your money, right? And so I'd much rather, live and die on my own sword versus somebody else who, their main objective is not to get performance. Their main objective is to collect funds for their mutual fund, for their ETF, just so they can obviously take the fees. So that is, some food for thought there, okay? Appreciate everybody joining me as always. Thank you, folks. 33,000 plus subscribers now on the channel. New all-time high. We're the hottest stock in the market, and I appreciate y'all being here. Also, guys, just so you know, I put together a nice new workshop for you guys last week. It's a free workshop. It's about a 30-minute video. Should get a lot of value out of that one there. That's going to be the pinned comment down there for access. Much love, and have a great day.